Well, good evening, everyone. Welcome to our UC Riverside Alumni Homebuyer Workshop. My name is Jason Maida. Great to be with everyone this evening. I appreciate you really taking time out of your busy schedules. I know a lot of stuff going on, especially on a Wednesday night, but I do appreciate you spending time with us this evening. We just kind of launched the webinar, so I'm allow everybody to get settled into the Zoom session. This is a very interactive session that we provide 4 times a year for the alumni community. And we put on these events to try to help promote really what homeownership is about and create, a path towards homeownership for you, to give you some tools and resources so that if you're looking to accomplish the dream of homeownership, you'll know how to get there and obviously what tools can kind of support you in that journey. Tonight's class is going to run us to about the top of the hour. We also are recording tonight's class. So if you have to step away from your computer, totally fine. We will also send you out all of our slides from this evening session, and the recorded version of tonight's class will be up on our YouTube channel. So feel free to check that out, and you can kind of look back at some of your notes on that. Well, my name is Jason Maida. I'll be your presenter this evening. I get a chance to present classes like this all across the country through our partnerships like UC Riverside. But I get the opportunity to work one-on-one with you to help you on your journey towards homeownership. So I spend most of my day working with clients in our local communities to figure out options around homeownership. And so we do that as a connection point to really help support you in this journey. Our organization is called American Pacific Mortgage, or APM. So we're one of the top 10 lenders in the country. Our team specifically focuses on really tools for first-time buyers that can help support you in accomplishing that financial goal. And again, our connection point with our community really starts with classwork like this. So we just get a chance to understand concepts and tools and, like I said, resources that are available to you, get you educated up, and then help you on that path towards homeownership. Our talking points for this evening look like this. So we'll spend some time talking about the housing market, what's happening both from the housing market, but also on the interest rate side of things. I'm going to walk you through, does buying make sense for you? Just given some parameters of around home ownership, especially looking at renting versus buying. Talk a little bit about credit and how we can maybe look at opportunities for improvement on credit, different programs that are available to you. Also talk a little bit about savings for home ownership, as well as first-time home buyer programs, the buying process, and then kind of how we take our next steps in the home buying journey. So don't miss the end of the class. And we definitely want to take you through, like, where do we go from here? Because it's great to obviously talk about these concepts in a classroom setting, but like, where do we go from here is where we're going to talk a little bit about the 6 steps of the home buying process. Excited to take you guys on tonight's journey in this session. Hopefully you have a lot of great things to take away as you're considering home ownership. And so let's kind of launch right in right now and talk about, does really buying make sense for me? And for us attending tonight's class, this is probably going to be the biggest financial decision we decide to make. So obviously, you understand the importance of it because you're spending an hour of your Wednesday evening with me learning about home ownership. But when we consider home ownership, I think there's a lot of key benefit elements that go into home ownership that we need to take under consideration. Things like affordability, which is a challenge in most markets, like the ability to be able to have a fixed payment on a monthly basis and not have to worry about my rent increasing every year that I renew my lease. For those of our clients that are purchasing in today's market, while prices are still remaining pretty high and interest rates are still high, there will be an opportunity for existing homeowners to refinance their home, which basically means I'm taking a new loan to take at a lower interest rate. So if 2 years from now rates go from 6.3 to 5.3, that might be an opportunity for me to refinance and lower my monthly payment. For those of us that are homeowners, this is probably one of our biggest assets that we have, maybe aside from maybe our 401k or retirement account. But it's an active asset that, as your home grows in value, creates more equity in your portfolio. So essentially, if I have a home price of $500,000 and that home goes up to $700,000 in the next 10 years, I've seen $200,000 in growth in purchase price. But keep in mind, I've also been making monthly payments on my mortgage. So as that mortgage balance goes down, that value rises. The difference in those two numbers is home equity, and that's a really huge opportunity for many of our clients, because that does have an opportunity to create generational wealth for families. There's also some tax benefits that come along with owning a home. Potential tax deductibility of interest, When you make energy efficient upgrades to your home, you can also realize some really great tax benefits on that side as well too. Now, as we think more about home ownership and really the differences from, where am I at today in renting versus what it could look like with buying, I wanted to share with you one of our tools that is available on our website. It's called our rent versus buying calculator. And it helps kind of reposition our thinking a little bit when we compare our budget today in renting versus what it could look like on the homeownership side. I'd encourage you to take a look at some of these tools on your own. This is kind of a snapshot on our website, but you can kind of see the different tools that are available here, like affordability, refinancing, general payment guidelines. So let's take a look at this. And I would encourage you to run your own scenario on this. But let's say I went out and bought a house for $600,000, right? And I was looking at putting the minimum down payment of 3%. That means I would be financing 97% of that purchase price, or $582,000. We'll plug in, maybe an average interest rate today, 30-year fixed mortgage. We make the assumption that, let's say we'll buy that home. I'm just going to push it out a little bit. Let's say June 15th, we're going to buy our house, right? Doesn't really affect the calculation, but let's say that's our timeline for buying, right? Well, if you put less than 20% down, you are going to have mortgage insurance. So we want to calculate that into our estimates. We factor in homeowners insurance, depending on what part of the state you're going to buy in. I assume most of our class is joining us from California. If you're outside of California, feel free to drop that in the chat. We can talk about other markets, but for those of us that are going to buy in California, there are expensive insurance premiums out there because of just fire hazards and whatnot across the state. But I think in general, average premiums I see around $2,500 to $3,000 for clients. And then we have the tax rate. Now that will also vary based upon where you're going to buy in the state. If you decide to buy a single family residence, you're probably not going to have HOA dues, more than likely. But if you're looking at a condominium or a townhouse, that could have HOA dues. And then we also want to factor in, where am I at from a tax perspective? And that's one of the things that a lot of buyers miss. They don't realize that, hey, I could potentially have some tax advantages of owning a home versus renting and probably paying someone else's mortgage. So let's put in our tax bracket. We have the cost of maintaining my house, selling costs, because eventually at some point in time, I'm probably going to look to sell my home. Appreciation for my home, so meaning how much will my home go up in value each year. And then this also assumes a scenario where a buyer is paying $3,000 a month in rent. They have renter's insurance, of course, and then their rent goes up 3% on an annualized basis. So when we look at our analysis that I'm going to show back to you guys, we have our rent column paying $3,000 a month in rent, and the assumption that we, again, buy a $600,000 home. So if I go up to this graph here, which is essentially a break-even chart, like how long is it going to take me to be on the plus side of owning a home versus renting? Well, it's 3 years in this analysis here, which basically means the investments that I make from a down payment perspective, closing costs, all those things that I'm going to have to put into my mortgage versus continue to pay rent, I break even in 3 years. And generally, we would want our clients to break even in about 3 to 4 years or less, of course. Now, if you're paying $5,000 a month in rent, well, those numbers are going to look a little bit better for you, right? Now, here's where I think it gets a little bit more interesting, or maybe exciting is the right word. After 7 years, look at this buy gain opportunity. I'm going to have almost a $94,000 opportunity of owning my home versus just continuing to pay rent of, so you can see here, like $280,000 in rent over 7 years. And we talked about home equity being one of the biggest asset classes that we have as a homeowner. Well, guess what? Now my equity is like $213,000. So, I think that's truly when we think about home ownership and, the upside of home ownership, those are the things we need to factor in. Now, everybody wants to find the perfect market entry point. It's very difficult to do. We can do our best to forecast numbers and whatnot, but it's hard to predict kind of where things are going. I would say if you talk to some of our clients over the last 3-4 years, getting into the market was probably one of their best decisions, because now they look back at some of their equity positions and they're in a much better spot financially because now they've realized the gains of home ownership. But as we kind of pivot a little bit in our conversation and talk a little bit about the housing market, I think we should kind of look at what are the trends in the housing market, what's happening out there. So let's talk about the Riverside housing market. Now, I know not everybody in this tonight's call is going to be looking at the Riverside market, but this just gives us a little bit of a snapshot of what we're seeing. So median sales price in Riverside area, greater region, is $632,000. Pretty much level year over year. You can see the number of homes sold, how long they've stayed on the market. Inventory is starting to improve, and we're going to talk about some forecasts in just a little bit. You're seeing a little bit of a dip in prices here, not significant. But I think one of the things that we are seeing is some homes are staying on the market a little bit longer. Maybe sellers have overpriced their homes. Maybe these are homes that just have some significant repair issues, whatever the case may be. New home builders are trying to pick up supply in areas like Riverside and San Bernardino County. You see a lot of our clients in SoCal that are buying in those new home communities. But I will say with those new home communities, they're great. It's the shiny object. It's brand new. It looks great, but they do come with those different expenses like Melrose taxes, sometimes HOA fees. If you're interested in new homes, definitely we should have a conversation about what that looks like for you, because there is a little bit of a trade-off when looking at resale homes or new home prices or expenses, I should say. Now, what's the forecast look like for 2026? Well, it's kind of changed a little bit because the world has changed since we made these forecasts, but we are calling for a little bit of a reset in the home buying market, a little bit better affordability because we still think interest rates can come down a bit. It is really day to day with interest rates, and we'll talk about it in just a second. The conflict in the Middle East has caused interest rates to change a little bit in some of these forecasts. I think as soon as we can get that conflict resolved, we're going to see probably interest rates hopefully get back on the path they were on back in February, basically, where we saw interest rates reaching their lowest levels that we've seen the last couple of years. But we kind of got obviously a little off kilter now. So where are we looking at price? Well, prices are expected to be modest, meaning we're not going to see any massive increases in prices across all the markets that we serve. And like I've mentioned, we see a little bit in the Riverside market, inventory looking to improve slightly in some markets. And so that's good for us because over the last 2 or 3 years, buyers really haven't had a lot of choices. And the question I get from a lot of buyers, and in fact, I just got this question today, is now the right time to buy? And that's like the big question. I do think for buyers that are financially in a really healthy position, I think there's a really great opportunity in today's market because when we have things going on economically, globally, that does create a little bit of fear factor in the markets. And some buyers will choose to be on the sidelines and wait, right? They'll wait for interest rates to go lower, wait for prices to come down, whatever the case may be. But as a prepared buyer, you can find an entry point into the market by being ready to go and seizing those opportunities that could exist in the market. Now, as we look at the general housing market for California, you can see kind of our last few years of the housing market. You can see 2025. This is kind of what we're seeing here now. So 2026 on the forecast, prices going up a bit, which is a 2% increase. Median home price, still pretty big number here for collectively across California, which is median price going up about 3.6%. Affordability improving just a bit just because of interest rates projected to go lower. Now, average interest rate, not at the 6% level yet. Interest rates today are right around the 6.3 to 6.4 level. It's been a very bumpy ride for interest rates, to say the least. February 27th, right about here, we're all super excited. Interest rates are going to go below 6%. And then, of course, the conflict erupted that weekend. And then we saw interest rates really start to skyrocket, touching up, 6.5. I even saw them go a little bit further up to here, almost to 6.75. It is going to remain a volatile market until things get figured out. We are watching what's happening with oil prices. Those of you that are going and filling up your gas tank, you're feeling it, of course. And I think that the key metrics that we generally watching outside of that would be what's happening with inflation, which the goal by the Federal Reserve is 2% inflation. What's happening in the labor markets? Well, we're seeing cooling inflation, which is good. We're not at 2% yet, but we're seeing some cooling inflation. And there's really some instability, I would say, in the labor markets. I don't think we've seen what's to come yet in the labor markets. So I think if we weren't dealing with what's happening right now with the conflict, I think we would see interest rates, really be down in this level here right now, closer to that, just hovering above the 6% level. So hopefully we can get from beyond that. The other thing I wanted to kind of just share with you from an interest rate perspective is that it's important to look at kind of the cycle of interest rates. And I want to kind of pay our attention to hear what we happened in 2021. Obviously, the pandemic rates hit their all-time lows of 2.5%, 2.6%. rate levels. Not likely that's going to come back again. And I share that with you because a lot of clients will ask, hey, I'm going to wait for those rates to go below 3% again. Well, that's probably not going to happen from the perspective that, unless something globally really is challenging happening, we're probably not going to reach those levels. So it is important to get the lowest interest rate that we can get. But I think there's also a timing mechanism to it because most of our clients that are buying in today's market, they're going to be considering refinancing. So if I'm buying a house at 6.4%, that's not going to probably be my forever loan. As rates hopefully trend down over time, rates reach, say, 5.4 or 5.3, then we're thinking about maybe refinancing at some point in time. Now, what's the best interest rate for me? Well, interest rates have different factors or elements that go into what makes up an interest rate. So we look at credit score and eligibility. We look at a loan product. We look at how much I'm going to finance, what my down payment looks like. And you do have the choice of buying what we call as points, where you're essentially paying additional funds out of pocket in order to bring down your interest rate. A point is usually 1% of your loan amount, and that equates to about a 0.25% reduction in interest rate. I don't recommend necessarily buying points unless you really have to in today's market because the break-even point is about 3 to 4 years for point investments. Now, loan term can also influence my interest rate. Now, what does loan term mean? Well, traditionally, we have 30-year fixed mortgages, but some clients will elect a 20-year or 15-year loan. It gives you a shorter term, quicker turnaround on a repayment, and generally will reduce your rate by 0.25% to 0.5%. As we get a chance to meet with you to determine your financial goals around home ownership through our consultative process, we're going to figure out what the right structure is for you with product and rate. So those are conversations we have in our 30-minute virtual sessions with you. Now, as we kind of move along in our discussion tonight, I want to talk a little bit about credit because credit's one of the biggest kind of movers when it comes to product and interest rate, as well as mortgage insurance. And we'll talk more about mortgage insurance in just a little bit, but every loan program does have a minimum credit score. And you can see some of those programs highlighted here. We'll also go through our product segment in just a bit to give you kind of a high level look at programs. When we look at credit from the lending perspective, we always take the middle credit score of all three agencies that report out. So for me, if my highest score is 760 and my middle score is 740, and then the lowest score that I have is 720, well, the middle score would be 740. So as a lender, that's the score I'm going to use from a qualifying perspective. Now, we all know the three agencies that report out: Equifax, Experian, TransUnion, right? We're all familiar with that. There also are three different models to credit scoring. There's actually more models coming out, but just in a basic level, there's the credit card model, which, by the way, that's used for most of your consumer reporting mechanisms. So when you're viewing your credit report to see what Amex is saying about your credit score, that is the credit card model. Then you have auto financing, and then you have a mortgage model, which, of course, is we're going to use in home financing. So that's, important to know because you may see Credit Karma showing you at 740, but maybe we pull your score and you're at 725. Well, there's a different model to mortgage than we would see in the credit card model. And I'll walk you guys through that in this evening's discussion. One other thing I wanted to point out to you when it comes to the middle credit score that we use, we look at the lowest middle credit score between both borrowers. So in my example, where my middle score might be 740, if my partner's middle score is, let's say, 710, we're going to use that 710 from a qualifying perspective, which will then determine my interest rate. Interest rates, mortgage insurance, they're at pricing tiers. So they kind of go in usually 20-point increments. So like if we can go from, say, 640 to 660 to 680 to 700, 720, 740, 760, 780. And then as we get beyond 70, 80 into the 800 level, that's where we're going to have our lowest cost options for clients. Now, elements on my credit report that are perceived negative items, late payments, collection accounts, when they appear on my credit report, that initial tag to my credit report, that's going to impact me in the most recent 12 to 24 months from the date of that event occurring. So if I had a late payment back in October of 25, it's probably still impacting my credit score. But as I get further away from that late payment, the more improvement I'm going to see in my credit score. Now, when we have negative items on our credit report, how long are they going to stay with me on my credit? Now, they impact me in 12 to 24 months, but depending on the credit type, this is how long they'll stay with you on your credit file. So if I had that late payment from October, once I get beyond 2 years, probably see some improvement in my score, but it's going to stay with me for quite some time, not till 32 is it's going to be there on my credit report. So This is a matrix to help you better understand how long that image stays with you. Well, when we look at the mortgage score model, here's what this looks like. And I want you to hopefully identify an area of opportunity in your own credit profile. So as you think about your credit report, and I'm going to give you kind of some insight as to what we're seeing with each one of these areas. Now, the first one is length of credit. That's, how long have I had credit? So the more mature my credit file is, probably the better my credit score is. So if I was to have two clients with one had a 6-month credit history, the other one had a 6-year credit history, everything else being equal, the 6-year credit history is probably going to be a higher score because it's just more seasoned credit. Now, moving along, there's also new credit. So how much credit am I trying to get access to? If I'm trying to open up new accounts, if I have creditors that are doing hard inquiries on my credit score, that is going to negatively impact my score. Now, there are rules in place for both auto financing and mortgage and financing that allows us to do as many credit inquiries as we want as we're shopping around, as long as it's done in a 30-day window of time. Now, in our process to start our virtual session together as we plan for homeownership for you, we only start with a soft credit check. And the reason why we choose to do that is because most of our first-time buyers, they're not going to probably run out and buy a house this weekend. In fact, we wouldn't even advise you doing that, but we're planning for future purchases, right? So we want to guide you properly, educate you up, but not impact your credit score. And so that's why we do a soft credit check that doesn't have any impact to your scoring. Next thing is going to be probably the best or the most opportunity, I would say, for most of our clients. That is around how much revolving credit do I have out there right now? What do my revolving credit card balances look like right now relative to my credit limits that are available to me? If I have $10,000 in credit limits and my balances are right now at $8,000 because I've booked all my summer trips, I'm ready to go vacation, well, that's probably impacting my credit score because my utilization is high right now. It's above the 50% threshold. What I would encourage our client to do is let's work to get that $8,000 in balances down to $5,000. Once we've mastered that, let's get to $3,000 or 30% utilization. And if we're really trying to effectively manage our credit card debt, try to get that to 10% or less. That's the goal really in mind. Now, when you're thinking about how I manage credit card debt, what I would encourage you to do is take a look at your billing statement, pull out any one of your credit cards. There should be a billing statement date and, of course, your due date when your payment's due. The statement date or billing statement date is when the credit card provider or issuer sends out all the data to the credit agencies. So my tip for our class tonight is if you can pay down those credit cards or pay them off ideally before they close out that credit statement, then you're going to get ahead of the reporting out to the bureaus, show a much lower balance, lower utilization, which in turn helps improve your credit score. Great practice to do, especially if you're getting ready to apply for something. Now, as you go through a consultation with us, we're going to kind of do some strategic planning around credit. So we'll do some of that for you, but great way to get ahead of things and help improve your credit score. And then finally is payment history, right? How have I paid my bills? If I have late payments, like we did the example of the late in 2025, that's a 30-day late, probably having a big impact to my score. The more severe my late is, let's say it's 90+ day delinquencies, then I'm going to probably have a bigger impact to my credit score. And again, that's in the most recent 12 to 24 months. Well, one of the accounts that does show up on our credit report is student loans. And with student loans, we got to identify the student loans and figure out how that is going to impact our qualifying. Now, when we look at different loan programs, there are different ways that we analyze those student loans. Now, if you're currently in active repayment, let's say you have an income-based repayment program and $75,000 worth of debt, you're paying $250 per month. That's great. We can factor that into the equation right away. We can take that $250 payment. But if you're in forbearance, and this is where it gets a little more challenging, if you're in forbearance or if you're in deferment, we really don't know what your payment is because the credit agencies show a zero payment. So in that case, when you don't have an active repayment, and I do realize many of you are now getting student loan letters from the servicer talking about, either just re-verifying your income for income-based repayment or payment programs or savings plans. Like that is happening right now. But until you're in an active repayment on an FHA loan, we do take 0.5% of the balance and then assess that as the monthly payment. So that would be $375. Or if you're applying for a conventional loan, it would be 1% of the balances, which would be $750. So that's kind of how we look at student loans. As I work with clients, there is a little bit of a concern that a student loan might be a limitation for homeownership. And I would say it's a good talking point for us that as we go through your consultation to see, hey, that amount of student loans, how does it impact my eligibility or my buying power? Shouldn't be a hurdle that we can't overcome. We just got to kind of collaborate together and figure out the best way to approach the student loan debts. And the reason why we have to look at that, because every loan program has guidelines around student loans. And so we're going to take a little bit of a high level look at different programs that are available to you now. Some of this stuff you've already probably heard about, especially if you've started to do some searching already. We'll start with the conventional loan, which falls under Fannie Mae and Freddie Mac. It's an adjacent government product, but it's really it's truly a standalone product. But it was taken under conservatorship during the housing crisis. Now Fannie Mae and Freddie Mac are in a really good financial position. They have about 60% of all originations across the country. If I'm a first-time buyer, I have a minimum down payment of 3% on that product. And there's a conforming loan limit. So if I'm looking at buying in Riverside or San Bernardino County, that maximum loan amount is $832,750. But let's say I'm looking to buy in West LA, right? And I need a higher loan amount. In LA County, we can go up to $1,209,000, I think it is. So I can go up to higher loan amounts. However, the down payment, once I go beyond this 832 figure, the minimum down payment jumps from 3% to 5%. The next product is FHA. That is a government insured loan. FHA stands for the Federal Housing Administration. It is government insured. There are some requirements around on eligibility for that program, specifically with both FHA and USDA, because they are government insured products. They do have residency requirements, unfortunately, which states that you have to be a permanent resident to access those programs. Conventional does not have the same requirement. You can be a non-permanent resident and still get access to Fannie Mae or Freddie Mac. But with FHA and USDA, we do have those requirements set forth by the government. The FHA product does have a minimum down payment. You can see here a little more flexibility in minimum credit scores. And then that maximum loan amount will vary based upon the county that you're going to look to buy in. USDA, it is also, like I said, government insured. That's for clients that want to purchase in more rural areas, zero down payment option. And the maximum loan amount will vary by the location. And there's two kind of bigger requirements, USDA. We look at income by household size. And then, of course, we look at the location. So if you really wanted to buy a house in Joshua Tree, right, in the desert, that fit really, what you were looking for in terms of lifestyle of a home, USDA would qualify in that area, but you would have to meet the income requirements and minimum credit score requirements. Now, for those of us that are looking to purchase maybe at a higher price level, it doesn't happen often, but there is jumbo loans for when we exceed this maximum loan amount for either a conforming or high balance loan. Then we get into the jumbo space, but it does have a higher down payment minimum. And then for our veterans that have eligibility for the VA home loan product, a veteran can purchase a home with zero down. There's lower credit score requirements, a little bit more flexibility in the underwriting guidelines. For those of us attending class that may be working on their residency right now or a practicing physician, there also is a physician's program that essentially gives us a lower down payment option, usually in the 3% range, but a little bit more of a relaxed approach to the qualifying for student loan payments. So if you're interested in some of those options, we can certainly talk about that during Q&A, or certainly drop any questions in the chat that you want to kind of cover on that side of things. Now we're going to kind of now go from product information to going a little bit deeper in terms of talking about private mortgage insurance, or PMI. There's a lot of misconceptions around PMI. So in classes, we like to kind of dive a little bit deeper and share with you a little bit more about mortgage insurance. Now, if you're doing a conventional loan, we have PMI, which is private mortgage insurance. If you're doing an FHA loan, there's MIP, or mortgage insurance premium. So let's talk about both. On the conventional side, PMI is based upon down payment, credit score, and then how much I finance. So the higher I can get my credit score, the higher I can put my down payment, the less cost I'll pay in mortgage insurance. Now, for those of you that started your search on Zillow or Redfin, you've already identified some homes and you're really excited. If you use some of the calculators on those sites, what I've heard is that the premiums tend to be a lot higher because they're not calibrated to these kind of characteristics that truly make up mortgage insurance. One of the benefits with conventional mortgage insurance, it has a cancellation option. So once I reach 2 years in my home and 20 to 22% equity, I can apply to have the mortgage insurance canceled. So if we look at an example of PMI, let's say I financed $500,000, I had a 740 credit score and a 3% down payment. My mortgage insurance is not terrible. It's $154 a month, so it's not bad. Certainly, if I can boost my credit score a little bit, that could also bring down that premium. On the FHA side of things, as we learned earlier, minimum down payment of 3.5%. That mortgage insurance premium does not change whether I put 3.5% down, or I put 5% down. The monthly MI is 0.55% of my loan amount, but there's another component to FHA, which is 1.75% as an upfront mortgage insurance premium. Now, I have this question or conversation quite a bit with clients because when you do searches online, FHA rates tend to be about 1/4 to 0.5% lower than conventional rates. And many first-time buyers, in fact, I was having a conversation with one of our clients in Fontana yesterday. They thought, I have to go with FHA because I'm a first-time buyer. Not the case. If you're eligible for conventional, you can do as little as 3% down. And the mortgage insurance savings is significant, as you can see here. With FHA, you'll see lower rates online, but FHA is not always the best product for all of our clients. So there is important to know that there are options for you. With FHA, there is no cancellation option for the mortgage insurance. In fact, you only can get out of that mortgage insurance if you refinance into a conventional loan. And then if we look a little bit further into the cost, we have our upfront mortgage insurance of $87.50 on the FHA loan, and then the monthly amount of $229. So you can clearly see there's obviously a big expense difference, but FHA is a great tool for us to be able to have that entry point to homeownership. Might not be the great fit for you. And if I'm a client that has a 740 credit score, conventional is probably where we would lean in towards more versus, let's say, if I'm a 640 credit score, FHA might be a better fit. But ultimately, we're going to figure out the right design for you as we get a chance to meet for your consultation, which by the way is a free service that we provide to our communities just to help educate you on what your buying plan looks like for homeownership. Now, we're going to start now moving into qualifying income for homeownership. And I wanted us to pass along some of the documentation that we generally ask for in the buying process. So as we get a chance to meet with you for your consultation, these are some of the pieces of documentation we'll ask for up front. When we'll take you through our get started process a little bit later in our class. But I do want to walk you through just a few employment scenarios that I think will be helpful for you as you're considering homeownership. Now, as we analyze income for our clients, we do have to evaluate the last 2 years of employment and/or education history. Well, what does that mean? Well, it means that I don't have to necessarily be on the job for 2 years. I just have to tie together my education and my employment. So especially when we teach alumni classes like this, we may have several clients that are attending a class, but maybe just started their job just recently, right? Maybe in the last 6 months. Well, if I can tie together my educational background with UCR and then my new job I just started 6 months ago, as long as I can make up that 2-year timeline, then that could help me qualify for my mortgage. You don't necessarily have to be on the job a certain amount of time. And we've had scenarios like right now where we have clients that are projected to start a job 60 days from now, but they have an accepted offer letter. We can use that offer letter to help them qualify for their mortgage today. Now, if I'm in a position that has variable sources like commissions, bonuses, maybe some RSU, restricted stock from my employer, if I do want to include those into my qualifying income, now that's a case where I do have to show that I've been on the job 2 years because we have to look at historicals in averaging clients' income. So we would take the last 2 years of income if I'm receiving something, like I said, commissions or bonus, or maybe even overtime in that scenario. If I'm a self-employed individual, let's say I run a business, I do have to show that I've been filing tax returns for at least 2 years in order to count that income for my qualifying. And I also want to point out to our class that if you have 2 employers, sometimes we have clients that work in multiple jobs. Let's say I'm working, in the healthcare industry, right? And I work for one employer 30 hours a week, another one for 20 hours. If I do want to count both the 30-hour work week job and the 20-hour work week job, I do have to show that I've been working both jobs simultaneously for the last 2 years. Last thing I just want to point out to you is if you do have a full-time job, but hey, you have some extra time on the weekend and you do Uber or Lyft or DoorDash, whatever the case may be, those sources like DoorDash and Lyft pay as 1099. So that would technically be 2 years of tax returns. I just have to display that I've been working both job sources for 2 years in order to count that income. So in analyzing our financing options and eligibility with clients, we also compare the income that we calculate versus the outgoing payments, things like the new housing payment, what their existing debts look like with credit cards, personal loans, car loans. We talked about student loans earlier. We call that debt to income ratio, which essentially takes into account your pre-tax income versus those monthly expenses. And we provided a little example here on screen, which is showing a prospective buyer that's paying a projected amount of $2,500 a month in their mortgage, $500 in current debts, and then they're making $8,500 a month. So the debt to income ratio calculation tells us that basically 35.3% of this scenario here, that client's income is being consumed by those expenses of 35.3%. But again, it's taking in consideration pre-tax income. The highest underwriting guidelines will allow us to go is 50%. So that's the largest number we can qualify on the debt to income ratio. Most of our clients that we work with or that attend classes, when they ask us a little bit more about, where should that number be? I would say that the comfort zone is usually around that less than 36% range. So probably 33 to 36%. The conversation we're going to have with you as we design your home buying options is to talk about affordability, right? And if I'm going from $2,000 in rent to $3,500 in mortgage, how does that feel? Does that work for me? Is that going to put me in a still good strength position when it comes to my overall finances? Last thing we want to talk about before we go through the process of what does it look like to go down this path towards homeownership is talk about really my down payment or my assets that are going to be used for my home purchase. When we think about saving up for homeownership, we're saving up for down payment, but there's also closing costs. Closing costs and prepaid items can be estimated at somewhere between 2 to 3% of our purchase price. When we think about where that money is going to come from, these are some of the acceptable sources that we can use when it comes to home financing. Obviously, checking and savings accounts can be used, but we have to make sure those assets season for 60 days. So if you move money around a lot or you have some cash deposits, cash cannot be accepted unless it stays in your account and seasons out for 60 days. You can, of course, use retirement accounts, brokerage accounts. I would just encourage you to talk to your financial or tax advisor before you access those assets. And family members can also help you out with your home purchase, where you're providing gifts to make up maybe the difference that you're kind of have a shortfall with your down payment. Family members can certainly help out. There's no seasoning requirement for that. There's just a documentation process. Well, when I think about homeownership for our clients that I work with, probably the biggest challenge is just saving up for homeownership. It's just because maybe we're new in our careers, we have some debt that we've been allocating a lot of funds to. I'm going to share with you first-time buyer programs on our next slide. But before we do that, I wanted to give you a really simple example of what we call a savings plan. In fact, I walked one of our clients on the East Coast through it this afternoon. And that's to take maybe what I'm paying today in rent today, say $2,000, and then look at my projected mortgage payment. So let's say after meeting with us for our virtual session, $3,500 is like the right number, right? What I would encourage you to do then as a buyer getting prepared to save more for homeownership is start saving like you're paying that mortgage payment today. So like the first of the month comes, of course, I pay my $2,000 in rent, but I create that discipline or that habit that an additional $1,500 a month goes right to my savings account, right? And I do that continually on a month in, month out basis. By the time I get to 6 months, I got $9,000 saved. By the time I get to 12 months, it's $18,000. So it's doing that and obviously building your savings up, but it's also creating that rhythm of, hey, I'm used to making $3,500 a month in payment. So when it comes to actually taking on the real thing of homeownership, doesn't feel like a big payment shock for me, right? Great way to do savings. And we're not taking in consideration potential high yield accounts that give you interest on your money as well. That can also kind of help increase that level of savings to prepare you for homeownership. So that's our savings plan. Now, first-time buyer programs are great tools that can help support you in kind of closing the gap from what you have in savings versus where you need to get to with your goals of homeownership. We're proud to be the #1 partner of the California Housing Finance Agency, which is designed to support low to moderate income households all across California. Now, some of you may have heard about CalHFA, especially in the news over the last 2 or 3 months because of the Dream for All program. That program recently closed out the lottery entrance last month on March 16th. We're expecting the lottery announcement to come out hopefully in the next 30 to 60 days. But beyond CalHFA's Dream for All program, there are also some wonderful programs that I partner with clients on every day. Like the My Home Assistance program provides up to 3% of your sales price in assistance on a conventional loan. If you're doing an FHA loan, it's 3.5%. And basically what it is, that assistance that you receive is a low interest rate loan at 1%. simple interest, and it does not get paid back at all until you either sell the home or if you refinance in the future. And there's also other programs available that we can kind of bolt on to the My Home product, like the My Access program, provides up to 2.5% of your loan amount in assistance, same 1% simple interest with all deferred payments. So a lot of great tools through CalHFA. If you're interested in that, it's a statewide program. Love to be able to kind of build that into your homeownership plan as well too. Now, nationally, we work with the Pathway DPA program. There's no income limit restrictions on this program. We have the APM 1% down payment program, which essentially means that for clients that make less than 80% of the median income, if they contribute 1%, we'll put in the additional 2% so they can get their 3% down payment met for their home buying plan. So there's other details to that, which we can cover during your home buying plan session. And then Golden State Finance Authority, available in the state of California. Probably an additional option if we can't qualify for CalHFA, but another good alternative for first-time buyers. Chinoa Fund's another product available for FHA loans. And then for those of us that qualify as, like I said, low income or even very low income, there's the Fannie Mae and Freddie Mac incentives that are available too. So there are a lot of great resources out there, and not everybody's aware of them. So, I think in this day of technology, there's a lot of great resources online, but I think it's important to understand what's applicable and really what you're eligible for in your local community, and certainly we'll help you through that as well too. I want to quickly just share with you a little bit more details on CalHFA since we primarily have a California class. If we were to look at buying a house, let's say for $500,000, well, the minimum down payment is 3%. But we also have to fold into our savings goal that closing costs and prepaid items. So probably if I'm buying a $500,000 house with the minimum down payment, I would need basically about $27,000 to $30,000 out of pocket. Where CalHFA comes in as a resource is now if I want to add My Home assistance and pick up an additional $15,000 in assistance, now I've just taken that cash out of pocket and dropped it from $27,000 to $30,000 down to $12,000 to $15,000. Maybe I need a little bit more assistance, and then I can add my Access program in, which is 2.5% of my loan amount. So really, in a scenario like buying a $500,000 house, you have about a $27,000 opportunity of resources that are available to you if you elected, say, a CalHFA program. Now, there are some eligibility requirements for the program. Minimum credit score of 640 for an FHA loan, 680 for the conventional product. If I'm considered low income, it's 660. Talked a little bit about debt to income ratio this evening. So it's 45 to 50% depending on our credit score. This is a first-time buyer program, which basically means you have not owned a home as your primary residence in the last 3 years. And the way we look at income on these programs, we look at applicant income, not the household income, which many first-time buyer programs do. So if I make $150,000 a year and my spouse makes $150,000, we're only counting the $150,000 in the application if I'm the only one to apply. And these are eligible for any really one-unit properties, so single-family homes, new construction, condos, townhouses, even manufactured homes, but those manufactured homes have to be on land that you own. Here are some of the income limits for the SoCal markets. If you're not in the Southern California market and you're buying in Santa Clara County, we'll put the link to the income limits in the chat for you. You can check that out. But all of these limits are all based upon 150% of the median income. And they do also change on June of every year. So we'll probably see those change again here in just a couple months. And certainly we'll post those out to our clients as we learn more about those changes. All right, well, we're rounding the finish line in tonight's class. And before we wrap up, I think this is probably one of the most important segments of class, which is just understanding the buying process. In fact, just before tonight's call, I actually walked one of our clients that's considering a home purchase through each individual milestone here, because understanding where we go from here after class, I think is really important. Now, the first thing we would do is encourage you to connect with us for one of our free consultations. That consultation starts with a really simple online application. We do have to do a soft credit check, like I mentioned earlier, then you upload documents. We utilize that to help kind of build a profile for you, and then you and I meet for a one-on-one session to design your home buying plan. We gain some agreement and goals on what we want to do, and then the output of that is a pre-approval. And what a pre-approval does is it shows your eligibility for homeownership. Doesn't mean you have to run out and buy a house today, but it gives you a baseline for homeownership. Yes, the pre-approval is good for 60 days, but it can always be recertified at any time. So that kind of launches us out to, if we so choose to, the house hunting phase, which is step 2. And some of us might already be here right now at house hunting because we've already looked at homes online, but really now you know your budget and maybe you have an idea of the communities you want to buy in. So the house hunting would be the next phase. You start probably online, but then we would encourage you to connect with a local realtor. We have some fantastic preferred realtors in our local markets that we serve all across the state and the country for that matter. We would encourage you to work with the realtor because they should be experts in their local markets. They should understand the walkability of a community, certain things to be aware of, and they should have a sphere of influence of different inspectors and whatnot that can help you make a good, sound financial decision. So let's say we found the right house and we're ready to go and we work with our realtor and we present an offer to a seller. Well, that seller may accept our offer, they may not, but in this example, let's say they accept our offer. Now we're going to move to step 3, which is called entering escrow. So we have a ratified contract with the seller. We have some agreements in that contract that say when we're going to close escrow, certain deliverables on your side as a buyer. And I'll be also made aware of the acceptance. And when I get the notice of that, you'll get a call from me saying, hey, congratulations, you got your offer accepted. Let's talk a little bit about next steps and let's schedule you for a follow-up video session so we can meet again virtually to kind of fine-tune all your financing, talk about your timelines, your action items, and make sure you feel comfortable with the structure of your financing. So we're going to do that within about 48 to 72 hours of your accepted contract. Now, you also have other action items from different, partners within the transaction, like the escrow company will reach out to you for your earnest money deposit information, which you're going to make a deposit, usually depending on the market, somewhere between 1% to 2% of your sales price. That will count towards your total out of pocket. And that's important to know because that deposit is going to count towards your out of pocket. But in most contracts that are written here in California, that will be protected by what we call a contingency period. Most markets, we're going to have a contingency. Some hyper competitive markets, your realtor may coach with you on maybe not having contingencies, but most clients I work with, especially first-time buyers, we're going to have a contingency, which gives protections to the buyer that if something goes a little bit sideways, you can have protections for your deposit not being at risk. What does that mean? Well, in those contingencies, you have your appraisal contingency to make sure the house is worth what you're buying it for. Inspections to make sure the house is really inspected and properly, make sure the roof is in sound condition, electrical panel looks good, whatever is something that's of importance to you. Then, of course, getting your loan approved. And we want to make sure that obviously we deliver on your financing. Those contingency periods can run as short as 7 days. They can be as long as like 21 days. Now, if we were to look at the overall time period from accepted offer here to when I get my keys and start moving, it's about 30 days on average. It can be shorter than that. I think our average transaction is probably about 22 to 23 days. Our shortest transaction be as quick as 14 days. All right, so now we got the house. We met with Jason. We've done the follow-up consultation. Where do we go from here? Well, step 4 is going to be the administration really process, where we're going to do some verifications of employment, assets. We're getting everything kind of structured. Now, we make a note here of rate lock. Now, rates vary during the trading day on Wall Street. They start at 6 a.m., they close at 2 p.m. Throughout that time, interest rates can go up and down, especially with the volatility in today's market. Once you're under contract with a seller and we meet with your follow-up consultation, we're going to start talking about strategy and when we lock in interest rates, because there is certainly some strategy to timing the market. And I consider ourselves to be experts on kind of really watching the market. It's not just a one-size-fits-all with interest rates. As we move through each milestone, you're going to be getting disclosures electronically sent to you. And then we'll move to step 5, which is the loan approval phase. That means an underwriter has approved my loan, says, okay, we got all this stuff. We have maybe some conditions of the loan. Our team will reach out to you for any of those conditions that we need to get. And then you'll also get a final closing disclosure at step 5, which essentially aligns all of your financing to what you've seen in previous disclosures and gives you a 3-day cooling off period to make sure everything just sets up to what you expected it to be, and then gets you ready for your closing of your home loan. And what the closing of the loan means is the day that you're going to sign final loan documents. You'll also on that day be delivering your final wire of funds to the escrow team. And then as your lender of choice, we'll actually also wire in the funds for the financing. That money will get collected by a title and escrow team. They'll make sure everything's accounted for. And then they'll record documents with the county recorder's office. They'll record a grant deed, which is the transfer of ownership instrument. And then they record a deed for the mortgage, which basically is your security, our security, I should say, for the loan. We'll get confirmation of those things being recorded, and then I get a chance to make my favorite call of the day, which is say, hey, congratulations, virtual high five, you did it. You're now a new homeowner. We have several clients that we get a chance to say that to each day. And it's really, truly the best part of my day, of course, next to teaching classes like this. But it's a huge accomplishment for our clients. What's great about our relationship with our clients is that it doesn't stop there once you get the keys to your house. I'm throughout the day talking to clients that are now growing into their homes the last 2 to 3 years and staying connected with them through our aftercare program, watching the rates for them because if there's a refinance opportunity, we want to make sure that we can act, giving them the HomeBot system tool to track their home equity, and then checking with them at least on an annual basis just to see what's happening. Just had a couple of those calls today. Clients that have bought their homes in the last year or two start talking more strategy around refinancing. All right, so that's what the buying process looks like. Hopefully that provides a little more context for you on what this will look like on a go-forward basis. If you're thinking about moving forward in the process and just want to put a plan together for home ownership, I'd love to be able to partner with you on that. It really is a simple process. It starts with these 3 steps, which is completing an online application. We do have to do a soft credit check, but it does not impact your score. Uploading documents that are required in the application, and then using our scheduling system, which is noted right here, just to book your free consultation. Again, this is a free service we provide to you. You don't have to run out and buy a house this weekend, as I mentioned before. It's just providing you just a game plan for home ownership. And what does that look like? Well, let's talk about budget. Let's talk about affordability. Where do I want to buy? What are some of the things I could work on my credit to help improve my affordability? Do assistance programs match up for me? Maybe we need to do a refresh in the home buying process. Whatever you feel needs to happen, we're going to accomplish all of those elements doing a 30-minute virtual session. As we're getting wrapped up for tonight's class, I just wanted to share with you some of our technology. We lean into technology as part of our team through mobile, some of our AI to create better efficiencies in our process. However, it does not replace the human element of really an important financial decision. So we're always available, whether that's phone call, text, email, just simply talking through concerns you have. We want to make sure that we're here, but we certainly want to leverage technology for the efficiencies and just staying best connected with your transaction. Well, last thing I want to share with you is our wonderful UCR alumni partnership. We provide a discount in services. So whether you're purchasing a home or refinancing, we provide a discount in services. Of course, we're going to have our quarterly classes that you're always welcome to attend and do a refresher course or whatever the case may be. We also have a network of other alumni partnerships that are available. And we teach the same, very similar classes to all across the country. If you've liked tonight's class, I'd encourage you to share this back with friends and family and coworkers. These are all open to the public, so you don't necessarily have to be just an alumni to be a part of them for the most part. But we'd love to have anybody that you think would recommend a class like this. Here's all my contact information. So if you want to kind of go through some scenarios, please feel free to reach out to me. I'm more than happy to answer any questions for you. We are going to open it up for Q&A in just a second. We have all of course, our socials here. We love what our community says about it in home ownership, whether that's in Google reviews or Reddit communities, talking about how we've served them in home ownership. And I encourage you to check that out. And of course, follow us on Instagram for some of the stuff we're kind of posting with different resources to help you on this journey into home ownership. Thank you so much for being a part of tonight's class. I know we have a few minutes left before the top of the hour. I just want to open it up for any questions that I can take from the audience. We have the chat open. Of course, I'm looking at Q&A. I haven't seen any questions come in tonight so far, but I'll stick around for as late as we need to answer those questions. So feel free to drop any of those questions in the chat or Q&A, and we'll get those answered for you now. And I just want to point out too, like if you do have some questions that are more in your personal finances, don't feel comfortable asking them in this type of session, feel free to schedule an introductory call. So you can also do that through our scheduling system. So using that book your appointment online, you can do that there as well too. We do have a question come in. And the question is, would it be better to focus on credit card debt or student loan debt to help with a credit score? Great question. So I get that often. I would say, we'd have to talk through it a little bit, but I would say focusing more on credit card debt because installment debt, which is what a student loan is, it doesn't move the needle in credit scores as much as revolving debt. So when I can lower that utilization, it's generally going to help improve that credit score. And thank you for the thank you in the chat. Appreciate that. Questions. All right. Well, I know I'm probably just in front of dinner time, or maybe you guys have enjoyed your dinner while we're doing this class. Thank you so much for being a part of our session this evening. I do hope I get a chance to meet with each of you to provide your own home buying plan towards homeownership. If I can be of a resource for you, please don't hesitate to reach out. I wish you guys a great rest of the week and look forward to seeing you soon. Good night. Yes, Natalie, we will actually, the class is being recorded. So as soon as I wrap up tonight's session, we'll download the file and we'll have it up on our YouTube channel tomorrow. You're welcome. All right. Good night, everyone.